Hey, good afternoon, everybody. Welcome to today's Backtesting Bootcamp. Got some people joining in now. We've got Jason. We've got a few more people logging in as well. Jason, you're the first one here. How's it going?
Good, how are you?
Doing well, thanks.
Do I need to have my video on?
No, that's quite all right. I'm going to keep the microphones on so that way, as we go through, you could jump in with questions at any point. The only thing that I would ask you and everybody else that's logging in is to just keep the microphone muted until you do want to chime in with something, just to eliminate any background noise.
Sure, sounds good.
Awesome. So let's jump in to the presentation. There's going to be a lot of back and forth during this presentation too. There's going to be there's a short slide deck just to give us the general overview of what we're going to discuss, and most of the work is going to be done looking at the actual spreadsheets that I've developed and looking at TradingView charting software that I like to use. All right, so let's switch over to this over here. Well, what is it? Screen number 5. All right, so Backtesting for Beginners Bootcamp. This is such an important skill for everybody to learn, and the reason why I think so. Actually, let me see. Why is this not transitioning? Here we go. Let me go back. Okay, so the reason why backtesting is so important for everybody to learn, and I learned this the hard way. Like, I was not the guy that did things the right way. Like, my story is that I've been trading now for a little over 20 years, but the first 10 of it was an absolute nightmare. And the reason why is because I did everything completely wrong and backwards. Well, what I did back then, I just had ideas and I started to roll with it. I tried to track trades and come up with plans, but plans quickly flew out the window. And the reason why is because I didn't have any confidence, like any real confidence, that what I thought would work. Like, whenever a trade would start to move against me, then I would start to second guess myself, second guess the plans, start scouring the internet or television or wherever for some kind of confirmation, right? Like, something to tell me if what I was doing was right, if I was on the right track. And so it wasn't until I started accumulating data the hard way, which is, just keep on throwing money into trades and seeing if they would work or not, that's how I accumulated my data. There's a better way that you can accumulate data, which is to come up with the ideas first and then do the things that we're going to learn here. But if you already have a lot of trades, right? This is going to serve you extremely well too. And part of the reason why is because you'll be able to see many of the key statistics of your systems and start to be able to generate new ideas of how to tweak your systems, get them to perform better. So let's go through the main topics of today's presentation. Today, you're going to learn how to set up spreadsheets, set up the initial spreadsheet to backtest your ideas. Everybody that's here today is going to receive a copy in Excel of the template that I've created. I'll email that out, and it'll also be in the members dashboard for all of you that are Mara Elite members. You'll learn how to pick the most important variables to test. You'll learn how to handle multiple variables at the same time. And again, the key statistics to calculate. So the tools that we're going to use today, we're going to use Google Sheets and we're going to use TradingView. Google Sheets is a spreadsheet in Google. Anybody could access it for free. You could also download it and put it into Excel and vice versa. So I have mine in Google Sheets. The downloaded version that I'm going to distribute is in Excel. It just makes it a lot easier to distribute it as Excel. So let's take a quick peek at the final product that we're going to have. And by the way, is there any questions from anybody before we dive in? I see a bunch more people signed in while I was doing the initial introduction. And let me show you this backtesting sheet I've been working on. So this is what we're going to be working towards. Here I have all of the trades that I've taken this year. So like it's like using like actual hard data in here, but I've normalized it to just say like, okay, start with a nice round number of 100 grand, and then I started to test all these different ideas. So you will be inputting ideas, we'll be setting up the different tests that we want to do. What would happen if price achieves a certain price or a certain R multiple? What would happen if you started to take profits earlier or later? And then calculating all of the key statistics over here. And we'll go through all this in just a moment. And this is what you're going to end up with. So let's flip back over here for a second. All right, so setting up the spreadsheets to backtest your ideas. The first thing that you're going to want to do, and I'll send you out a PDF of this slide deck as well, but of course feel free to take your own notes. But we're going to start by entering all the trades that you've taken. If you have a long list of trades that you've already taken this year or years prior, start by entering the trades that you took this year. If you have over 100, fantastic. If not, try to enter 100 trades. I don't know if you saw on the spreadsheet so far, I've entered a little over 50. So I still have some work to do on this sheet myself for entering trades. But in order to get to statistical significance, and this is worth jotting down, in order to get to statistical significance, you need to have 100 trades. If you have less than 100, then you might have some good data, right? Like at 50, I'm able to see like, is this a test that's still worthy of my time and effort? Because like if you have absolutely horrendous results after 50 trades, then it's not worth continuing the test. Like you could abandon the idea and move on to the next thing, and that'll be a great way to save time. In fact, if I would say after your first 20 trades, if you have god-awful results, like let's say the worst case scenario, you have 20 losers in a row, then that's probably not a system that you will want to trade live, right? Like even if, let's say that this is a system where you lose, or a system that theoretically a system, 100 trade system, it loses 99 times out of 100, but on that 100th time, you could make 1,000%, right? So the system is a fantastic cinema. It like the system can win, but nobody is going to be able to trade that smart, or I shouldn't say nobody, but like very few people would be able to sit there and trust a system that loses 99% of the time, even knowing that that one time they could hit that 1,000% gain. So the system has to be tradable by you, and you would want you could most of the time you could start to see like if it's a system that's worthy of your time and effort after the first 20 trades. If not, like by 50 you start to get a better sense. But to have true statistical significance for your trades, meaning that this is a good sample size, you need at least 100. So enter your trades, and then you'll enter each of these columns. These are the columns that I have in the template that you'll be getting at the end of this. Entering in, and let's flip back over to the spreadsheet. So screen number 6. So you'll be starting out with this. You'll enter each of these columns here, and you'll be entering in all of the trades that you've taken in this column. And yeah, you want to track the instrument or the ticker that you're using, the date that you entered the trade, the setup, the price that you entered at. Start tracking market conditions, and you can see too, like how that like I've progressed as I've done the sheet as well. From when I started, like I had a sense of what I wanted to say for market conditions, but then like as we progress like through the year, it changed to where I'm using this shorthand, where for anybody that's attended the deep dives that we do on Saturdays, we look at the major indexes across timeframes, monthly timeframes, weekly timeframes, and daily timeframes, and come up with an overall picture of, are they moving up, down, or sideways? This is saying like on this particular week when this trade was entered, the market was moving sideways on the monthly, sideways on the weekly, and sideways on the daily. And when this trade was finally exited, it was in the same condition. Didn't have that installed up here back in February. So this game is about continuous improvement, and nobody's perfect. And I certainly don't have all the answers, but as we continue to play, move forward, and improve ourselves, we gain more and more. The TP price, that's take profit price. So like the ultimate target that you're trying to achieve. SL is the stop loss price. Starting risk, you want to have it in percentage. So how much of your capital are you going to put at risk per trade? How much that translates to in dollars. The risk per share, right? So it's just simply the risk per share is going to be the entry price minus the stop loss. You can come up with the percentage risk per share, the position size, and the number of shares. I've actually rounded all these numbers because, well, when you do the calculation, you end up getting decimals for the shares, and so I would just round to the nearest round number. And all of the calculations are in here, right? So you can see that like risk per share is going to be the risk per share in dollars divided by the price, and you could see the calculations for all of them. We don't need to go through that. calculate your position size in dollars. And then over here, this is where it starts to get different for everybody, right? Like, well, what you use for trailing stops. If you use trailing stops. For me, I like to use a series of moving averages, predominantly the 5 EMA, the 10 EMA, and the 21 EMA. The reason why I like to use those is because I'm a momentum-based swing trader. And that means that I'm aiming to get in and to get out relatively quickly and to stay in trades so long as they have upward momentum. And so I'll be selling before like a long-term investor, for sure. Right? The long-term investor will be able to have much larger gains than I will because they'll be holding for a lot longer, but they'll also be sitting through drawdown periods that I'm personally don't want to do. Like I'd rather have the greater turnover in my portfolio. Also calculate the backstops and how many backstops you're going to have in your trade. What I consider a backstop is where you are trading where price falls below support. So for example, like here's a chart of Amazon and one of the trades that was taken. So Amazon was actually traded a few times, right, that you can see on this chart. The first time was back here when we had this gap up move, and it ran up and then quickly came back down. One of the backstop idea that I use is when price forms a new level of support, right? So a period where it's trading sideways, I will raise my stop loss below that level of support. Well, once it's established, and once price falls below it, then that's it, I'm out. But what this means, 20% minimum for me, is that at least that 20% minimum of the trade will be dedicated to a backstop. So if price just runs and runs right past the target that I had, then the remaining portion of the position, at least 20%, is dedicated to just continuously raising the stops until we fall below it. Over here, this is a column for profit targets. And again, you would want to set it up to whatever your profit target parameters are. For me, the way that I have it set up here, every time that I make 1 times the amount that I've risked, then I end up taking a little bit off the table, at least in this particular test. So for example, 1R over here, the value of 1R is 2.75%. I risked 2.75%. So once I've made 2.75%, it would take a little bit off. Once I've made, what is that, 5.5%, take a little bit more off, and so on and so forth. For this particular idea, that's how it's a great way to continue to sell into strength. And when you have a tighter entry point and stop loss, it also allows you to have a much larger position size. So for example, like you see right here, right, this column N, the position size at the start, this is actually, I think that might be the largest position for the entire year. Yeah, yes, it was. So that's, and it makes the math real easy, right? Like round number 100,000, 37% of the account was in this one trade, but I was still only risking $1,000, still only risking 1% of the capital, and this trade idea had the potential to run or where I thought that it might be able to go. I thought that it would could go as high as 2,300 at the time, and that would have been a little bit better than a 4-to-1 reward to risk. And part of what allows this to be such a lucrative trade is that like you gain those R multiples so much quicker when you're able to enter with such a tight reward to risk. All right, so we have all those columns, and then towards the end, you would want to have your ending position size, the ending, whether you had a gain or a loss for that trade, both in dollars as well as in terms of R, your reward to risk. And then these columns over here, this is just collecting data, so that way this is a data field for this column over here. So it's just simply adding up the number of trades. So 51 trades. And then this column over here is looking at column AM for whether it's a gain or a loss. And that way it's tabulating up here. So we could see like what's the biggest winning streak, what's the biggest losing streak. And it's important to know that for your systems. So that way you know like, well, what's normal in your system and what's outside the norm. In this particular way that this is constructed, like if you're somebody that once you have like 3-4 losses in a row, and you're up to 5 now, you might start to throw the whole thing out the window. But the way that this is constructed here, 6 was the max so far, and we're only up to 51 trades. So once we get to 100, maybe that losing streak increases. Maybe it becomes 8. Maybe 6 is the maximum. We don't know yet, but this is why it's important to have statistically significant data and to test in this way. Any questions so far? I believe everybody's microphone is open or able to be open. And forgot to mention it at the top of this. If you scroll down to the bottom of your screen, you should see a chat box somewhere, and you can use that little chat bubble, or I think there's a Q&A bubble as well. Feel free to use those if you wanted to keep yourself unmuted, and I'll keep an eye out for anybody that uses the chat. All right, so let's come back over to presentation. All right, so picking the most important variables to test. Now, well, when you're trying to think of like, well, what kind of test you want to do, the first thing, like, because you could really go in any number of directions with backtesting, and the more that I've gotten into backtesting, like it to me, like, as crazy as it is, man, maybe I'm just like a nerd, but like to me this is fun, and it's interesting to start to see like how different ideas start to play out, and how all these different factors come into play, a lot like how what some things that you thought might be a good idea or a bad idea end up being turned on its head, and how like you could really have like gain a lot of confidence in an idea very quickly, and you could also dispel a belief that may be a limiting belief very quickly as well. And the reason why is because you have the evidence staring you right in the face. So step one is to consider the result that you're after when you're backtesting. Some people may want to hold for the bigger move. You might want to lock down gains faster, and you want to test for that. You might want to set up something where you can take fewer losses or give back less profits. Like each one of those are going to be drastically different tests, and that's why trading, while we can all look at the same charts of Amazon, Apple, no, whatever. We're all going to trade it in different ways, even if we're all trading using the same kinds of methodologies. We're all going to see it in our own nuanced way, and it comes from this here, from that step one, where we're all after slightly different different things. But once you come up with this idea that you want to test, then you want to input it into your notes in the spreadsheet, and I'll show you that. And then you would want to begin your test. So let's switch back over to the sheet. So you would want to just enter it right in here. Right? So if you click into the cell in Google Sheets, you just right click and then you would click insert note. You could do comments as well. I prefer note. It's the same thing in Excel. And so this is just telling you what I was testing here. So I set the amounts for the trailing stops, backstops, and profit targets, right? So so each one of those over here, the trailing stops were 30%. Like I mentioned earlier, each one of them would be equal, right? So 10% for 5, 10% for 10, 10% for the 21 EMA, and these are closes below those levels. Then, we spoke about the 20% for the backstops. If a trade falls below the backstop, then I would exit the position, but I would leave enough of the position open for there to be a minimum of 20%. And then 50% dedicated for profit targets. So as the trades are running up, as I'm making progress in those trades, once it's achieved 1 times my risk, 2 times my risk, etc., I would be scaling out of the position on the way up to 50% of the trade. And all that is in here. And you want, whenever you're doing any kind of a test, you want to have notes like that at the top. So when you go back to look at this, because like this isn't going to be the only test that you do. Once the hardest test that you do is going to be the first one. There's going to be a lot of manual data entry, a lot of flipping back and forth from charts. So like if you have this open, like you'll be flipping back and open to tabs. If you have, and this is where if you do happen to have more than one screen at your disposal, it makes life a lot easier. Where you could have the spreadsheet on one, the charts on the other, and you're looking at both of them at the same time. But yeah, like the first part of it is a lot of checking back and forth, and entering it. And yeah, it does go slow the first time that you do it. But once you're done with entering the first batch, then as you have other ideas, you could use the same trades that you entered, right? Because like everything here are trades that you've taken. Either that you've taken or that you've had an interest in. If you are like, let's say that you are brand new to trading, or that you haven't taken any trades, you could populate this with whatever you want, and then you could use that set of data to change what it is that you want to test. So here I have 3 examples, right? So there's this one. This is the same trades, right? Same exact trades, but well, what I was testing on this one was this, where instead of what we did in the first back test, I wanted to see what would happen if I front loaded the my sells, meaning that at 1 times my risk, I would sell 10% of the position. At 2 times my risk, I would sell 50% of the position. And the reason why I wanted to test this was because when I did this test, this first test, well, what I noticed in looking at all the profit targets was that very few trades made it beyond 3R, right? Like many of them hit 1R, many of them hit 2R. Then at 3R, it starts to thin out a little bit, and then very few made beyond 4R, 5R, etc. So wanted to see, well, what would happen if I took my profits a lot faster, or the majority of my trade out faster. Yep, the same rules for the trailing stops, and that was it. But then on this third test, I wanted to test something completely different. On this one, I wanted to see what would happen if I, number one, only use the 21 EMA as my trailing stop, and what would happen if I sold everything on a close below the 21 EMA, and what would happen if the only profit target that I used was the ultimate target, and if it did happen to achieve the ultimate target, to sell half of the position, and then selling everything else at the backstop or the closest reaction low. And the results were, yeah, like significantly different. We'll go through that. Like I want to hold off on going through the stats now, because we'll get into that in the next segment. Any questions on anything so far?
Mike, this is Sal. Can you hear me?
I can hear you. You're a little bit low, but I can hear you.
Yeah, my question is the back testing, is this done on paper trades or is this real trades?
For me, these are the trades that I took this year, but it doesn't have to be. It could be paper trades. It could be ideas that you have. So let's say that there's a new setup that you want to test before you actually threw money behind it, right? Like so you're here today and you want to test out something. So what you would do in that case, then you would pop open your spreadsheet, start filling it in with the trades that you find. Like let's say that you wanted to test gap up trades, and you came up with the methodology already of what it is that you wanted to trade. Well, for me, here, if I wanted to, let's sort this data, sort range. And let's say I wanted to sort by the setup. So let's say I just wanted to look at the breakaway gaps. Well, there's really only there's only 2 of them in this example. So I would so that's like, all right, I want to test more breakaway gaps, and then I could just go and look for them in charts. Or if I have something like like TrendSpider. This is one of the things that TrendSpider can be good for, is scanning for gaps. They have a market scanner, and one of the scans that, oops, if I could spell, yeah, you would be able to scan the market for gaps and then try to, right now it's scanning the Dow Jones, but let's say we wanted to scan the Russell. You would then be able to go and look for other gap up plays and then come up with whatever it is that you want to test that way. And that would be a way to begin to compile data and to go through and test it. Does that answer the question?
Yes, Mike, thanks.
All right, cool. All right, so back to this. All right, so handling multiple variables simultaneously. We kind of went through this. One. It was where, like, if you already, step one is creating the main spreadsheet, and that's going to be the most time-consuming part. When I was doing backtest 2 and backtest 3 a lot, like, it took me about an hour and change to complete those two, because I already had the bulk of the sheet filled in. It was just like figuring out, like, well, what things do I want to tweak, and then going in and tweaking them. Once I had 100 trades, it would probably take about 2 hours. I would say a lot, like, and that's like no time at all for something that's going to end up either making you a fortune or saving you a fortune, because you're not putting money into ideas that you're just kind of hoping for the best. Even if they're something that seems logical that should work, better to go and test those ideas first. So you would just copy the sheet that you made, paste it, not past it, but paste it into a new sheet, and decide on the variable you want to tweak, and then run your test. And then we have all the different statistics that we want to look at and consider. So let's go back to the sheet and look at those. Again, you'll get a copy of these slides, so that way it'll make it a little bit easier for you to, when you're creating your own or editing, you'll be able to have these to refer back to. Jason, would you test differently if you were only testing against potential trade ideas? For example, keeping those in a separate list. Good question. So let's come over here. All right. So if I were testing, say, a brand new idea that, like let's say that I want to test, like, I came up with a new setup, right? Like no setup that I've ever used before, and I just wanted to see what would happen with that setup. Then you could, like, there's I think that there's two ways to do it, right? Like, you could either start a brand new sheet for that idea, or you could start adding it to an existing sheet and then filter just on that idea. It might be cleaner to do it as its own thing. So like, or to set it up as trades you've actually taken versus test ideas. I think that that's what I would, yeah, well, now that I think of it, that's how I would set it up. I would differentiate it by trades that like I've actually taken these trades, like the way that I've managed these trades, like this is not how I manage the trades. These are all like different ways that I've tested, but these are like literal trades that I've taken throughout the year. And on a different sheet, then I would have like trades that maybe were on the radar that I didn't take for whatever reason, and just see like, well, what would have happened if I took this trade that was rated a 5 on the trade gauntlet. For mentioning the trade gauntlet, like everybody knows what it is. Some of you do, some of you may not. The trade gauntlet is a piece of software that we've developed in-house. And well, what the trade gauntlet does, it's basically a weighted average checklist for trade ideas, and it has all the different parameters of things that I personally look at, and it assigns a value to each one of those items. And then at the very end, as you analyze a trade, you come up with a composite score. And if the score is high, say the score is 7 or an 8, then that means that 70 or 80% of what you look for in a trade, this happens to have. And so of course you would want trades to have more of the things that you want them to have to take the trade. If it scores low, if it scores like say a 4, then that means that of what you consider healthy for a trade, that it only scored 40%. Should you be trading things that low? Well, you could do a back test and see what would have happened if I took trades that were 4 or less, or 5 or less, 6 or less, well, whatever it is that you want to test, to go test that and see what the results will be. Yeah, in fact, I think that would be an extremely interesting test. Other questions? All right, so let's look at some statistics. Now, other things that you want to track, there's these are the key things right up here that are important to track, and we'll go through what they are and why they're important. You want to track the number of trades that you're taking. That one should be a given. Part of the reason why too, you'll start to have an idea of how many trades you take in a given period. However, so if you're a day trader or a scalper, you might be taking 51 trades a day. You might be taking more than 51 trades a day. You might have 100 trades. I know scalpers that have 200 trades in a day. For me as a swing trader, this is 51 trades since February. Like, so there really is no right or wrong answer to number of trades. It's more about like what's right for you, what's right for your system. Are you trading a system that fits you, your objectives, your beliefs? And as far as the actual test goes, do you have enough trades to be statistically significant? Then you want to track the number of winning trades and the number of losing trades. So to get that calculation, it's just looking at this column here. I could have gone with this column, the dollar gained or loss, but I chose to go with the R multiple gain or loss. And so it's just the column, and is it greater than 0, then it's a winner. If it's less than 0, then it's a loser. And the winning percentage. So this is significant to look at too, right? The way that this test was set up, And this is the sell everything on a close below the 21 EMA, sell half if it gets to the ultimate target, and then sell everything on a drop below the closest reaction low. Trading, well, with just those 3 rules, right, or 3 trade management rules, the system generated a winning percentage of 37.25%. But overall, it made money in 51 trades. Yeah, well, once it gets to 100 trades, like assuming the same results, then that would be what? That would be approximately a 34% gain for the year. The biggest winner. Biggest winning by R multiple. So this is just looking at the R multiple gain or loss and looking for the max. This is looking at the same column and looking for the biggest loser. With this set of parameters, there were 2 trades like right in the beginning of the year that got below the stop loss. And so it's important to understand what the biggest winner in a data set is, but also what the biggest loser is too. And when you do have up to 100 trades, or like if you have more than 100 trades, great, then it will really help you in figuring out the biggest position size that you can have. If the biggest losing trade can lose 2.7% so far, and like, let's say I have 100 trades, let's say I have 500 trades, and that turns out to be the biggest losing trade, then I know how it's going to affect how portfolio heat can be affected. And so, for example, let's say one day the market gets smashed and I have a couple of trades that end up being big losers like this, right? Like these 2 trades both were stopped out on the same day, right? So that's about 4%, lost 5% almost, loss in the portfolio. So it's good to understand what's the biggest potential loss that you can have. Rather than experiencing it in real time, you could go and look at the data and you already know what your worst case scenario is, what the worst case drawdown is. You could expect it and then be able to come up with a position sizing algorithm to best fit your system. This shows the average size of your winning trades, the average size of the losing trades. And then we'll talk about this section here last. Total gain, that's just adding up the gain loss column in dollars. Same deal with the total R, just summing up this column here for R gain, the loss. Yeah, here, this is showing the biggest winning streak, the biggest losing streak. So just for comparison, right? For the first back test, the biggest losing streak was 6. For this one here, for back test number 2, biggest losing streak, 6. For this one, the biggest losing streak was 10. But also look at what the total gain was, right? Let's look in terms of R, right? Like, so this one, 16.94 total R. This one, 15.87. This one, 15.41. So you actually, so far, this is the best performer. Again, well, we can't say conclusively before we get to 100 trades, which is the better system for now. But But so far, even sitting through a losing streak of 10 and having the lowest winning percentage of the group, this winning percentage over here, 45 winning percentage, this one was 41%. This still has the biggest return. So let's talk about these statistics over here, which are a little less, a little bit more advanced, I should say. So expectancy, what's expectancy? Expectancy is the amount that you can expect to make per trade if you continue to trade your system. So it's looking at the total number of trades and your total R and dividing it. So per trade, you would expect to make 0.33 R per trade with this system. Again, so far. Then these two calculations, the standard deviation and the square root of the trades, both of those are pretty simple calculations. Excel does it for you. It's just taking the entire R gain slash loss column and putting in the standard deviation formula there. Similarly, for this, for the square root of the number of trades, so it's looking at AG1, the number of trades, and giving us the square root of that. But what we're really interested in is this score here, the SQN, also known as the system quality number. What's the system quality number? A system quality number is a concept that Van Tharp came up with. Van Tharp is one of the people that Jack Schwager profiled in his book, Market Wizards. He is a neurolinguistic programmer, and he is somebody that's modeled some of the best traders in the world, deconstructed what they've done, and tried to come up with answers for their systems, and also a statistician. So he would look at all different trades and try to come up with like, well, what makes the best systems? And he came up with this formula that would show us that, or his research shows that the higher the SQN, the easier it is to A, trade the system, but B, to use different kinds of position sizing strategies to meet your objectives. So when the SQN is low, and so far 1.2 is it's not a terrible score, but it's on the lower side. What he would suggest is to look for numbers between 2 and 3. So we don't have enough data yet for this test, but if you have an SQN score between 2 and 3, that's considered a pretty good, pretty solid system where you could use a bunch of different position sizing strategies to meet your trading objectives. And the lower the score, it doesn't mean that the system is a terrible system. It means that you are limited in the position sizing strategies that you're able to use. So like with this one, right? Like we've got an SQN of 1.2 so far. This one has SQN of 1.6, and this one has SQN of 1.29. There's a lot more flexibility in position sizing in this one than there is in this one. Part of the reason why, like you could see too, the low batting average, the losing streak. If you are looking to risk not 1% of your capital, but say 2% of your capital, then this system may have lost you Well, like the average loser, right? The average loss is just under 1, right? 0.83. So 10 losses in a row, that you just lost $8,300 with on this account, right? Like that's why we like to use nice round numbers for testing. $100,000 account. The average loser is losing you 0.83 times 1,000 times 10. You lost 8,300, which might sound substantial to you, right? Like to some people that might sound like a lot. To somebody else, it might not sound like a lot. Like you would know best if you're comfortable sitting through an 8% drawdown in your account, or if you're not. It's very important to understand what you're comfortable with. But in looking at this data, it also shows you, well, could you ramp up to a risking 2% of capital? What would happen? Well, it's a lot easier to come back from an 8% drawdown than it is to come back from a 16% drawdown. That it is to come back from a 24% drawdown, right? Like let's say you wanted to get real aggressive with your position sizing and you wanted to risk 3% of your trading capital. Well, with this system, at one point you would have had a 24% drawdown. Like, could you sit through that? I personally could not. But if you have another strategy like this one, your biggest losing streak is 6, right? So in this case, you would have lost what? You would have lost 7,000. No. Hold on. Yeah, it's easier to deal with round numbers, but yeah, like you're losing significantly less on this one, and it might be easier to trade, but well, what's easier to trade, you're sacrificing in the gain under this system, right? Maybe you use a different position sizing strategy on this one. So maybe the next test that you would run, you would copy this entire thing. All right, so let's just do that. Let's add another sheet. And let's say we want to start risking 2% of capital. So for all these, we start to risk 2% of capital. Now, with what I've done in the way that I've entered this data, there's some calculations that I need to go back and manually do again, because with the position size, I rounded up. But you could then see like how much easier is it going to be to, when you have an idea, to go and test the idea now that you've had your first set of ideas, and then see like what happens. Questions? Questions, thoughts? All right, so should we run through a few examples? We could look at a few trades that were actually taken. If you don't have any other questions at this point.
Hey, Mike, this is Jason.
Hey, Jason.
Hey, you were looking at can you go back to your backtesting spreadsheet?
Yep.
In the middle tab, the backtest 2 tab, why did that one end up having a higher SQN score?
And why did this one have a higher SQN?
Yeah, what leads to that having a higher score there?
All right. So on this, remember what's the SQN looking at? The SQN is looking at the expectancy, and it's dividing it by the standard deviation, and it's multiplying it by the square root of the trades. So the reason why it has a higher SQN is because there's less variability in the results. Like that's what helps lead to the higher SQN. There's less variability in the results. There's more wins within the system so far, right? Like so far, let's move this tab to the very end. This one has the lowest winning percentage, and it's also the lowest SQN score. This one is the highest winning percentage, and the SQN went up. But also baked into the SQN is the actual size of the wins. Right? Why don't we do this? Why don't we delete some of this stuff here? And so we could see like how this starts to play out. Right? So you need at least 2 to get this here. Right? Actually, let's delete all this stuff too. Now we'll pull down. So the SQN starts to become meaningful once you have a decent number of trades. Like I would say, like at least 30 to see like if you would want to continue testing or just throw it out altogether, or you might want to, like, if you do have 30 and you do have like decent results, then continue testing to 100. Right, so far we have excellent, the SQN is through the roof, right? But we only have 3 trades, so we don't know how this is going to be just yet. Uh-oh, we've got our first loser, and look what that did to the SQN. Not only that, like it's a big loser, right? So as far as the standard deviation goes, there's a pretty big width between, a pretty big deviation between the size of the biggest winner, the size of the biggest loser, right? Like it's not a one-to-one thing anymore. It's the biggest winner is 1.6, the biggest loser is 1.5. That's pretty big as far as like trading wins and losses go. Here's another loser, right? And that tanked the score even more. Now we've got a decent sized winner here. Brought the score back up nicely. But we want to be very careful with, again, like judging a system with just a handful of results. What'll happen to traders, especially when they're new, that they start to test the system. And one of the most, and this really does speak to why one of the worst things that can happen to a trader to a brand new trader is having instant success, because not only do they think that they've got like a special knack for trading, and maybe they do, but that they don't see like what can happen later on, right? Like this was was this the one? No, this one, like this is the system that has a 6 trade losing streak. Like that, they might start to get into like the 4th loss or the 5th loss and start to think that something's wrong with them, or something's wrong with the market, and not understand why. And then they end up tossing a system that's perfectly fine. Like so far here with 13 trades in, we've got almost a 54% batting average. Our biggest winner made us 4 times our risk. The biggest loser was a 1.5 our loss, and on average, like that's pretty good for an average size winner and an average size loser so far, right? But we're only 13 trades in. Now we're 21 trades in, and you can see now too, like with this particular system, where we're taking our gains faster, the size of our losers are going down. And so far, biggest winning streak is 3, biggest losing streak is 3. All right, that's pretty decent. In 21 trades, we've made about 11%. And for each trade that we take so far, you would expect to make 0.5 R. So well, when you look at your trades in terms of R multiples, it helps to normalize the trade, like on each one of these trades too. And let's look at this. On each trade, the position sizes are completely different. Right? Like on this trade down here, you have $22,500 in the trade. This one up here, you have $37,000 in the trade. But on both of them, you're risking $1,000. On all of them, you're risking $1,000. All the percentages are different, but the risk, what you have at risk, is the same. So looking at your trades in terms of R multiples are very important. Oops. Need to carry this down as well. We've got 34 trades, and we've got a 53% win rate. The SQN here, right? Like at this point, the SQN looks fantastic, right? Over a 2. We're winning the majority of our trades. We've got a 18% gain, only 34 trades. Let's say that we make on average 100 trades a year, right? Then this system we would expect to make us times 3. We'd expect to make about 55 grand. Or 55% with this system. But we're not at statistically significant data yet. We have enough data so far to say, wow, this test looks amazing, but it's not at the point where you would just start to throw all your money into it and start trading a lot. Like you might start to trade this way, but it's not where you have enough evidence to warrant it to be statistically significant, and therefore like it still could fall apart. And in fact, that's what happens later on, right? So we add in the rest of the trades, and you see how SQN drops significantly, how the win rate drops significantly, because that's right where you got the losing streaks with this system, right? Before, the biggest losing streak was 3. Now the biggest losing streak is 6. And not only that, you had one losing streak almost with another big losing streak right on its heels. Does that mean that something's inherently wrong? Like, no. Like this is just a test, right? Like we're just testing ideas. But if you just are operating in the market and you're going off of a plan that you happen to hear somewhere that you haven't done this actual work yet, then that's where the jitters come in, because you don't know what's normal or what's abnormal. It's possible that a winning streak is right around the corner in this, but we don't know because we don't have statistically significant data yet. This might have an SQN of 3 or 5, be like a holy grail system. But again, we need more data. Excellent question. Other questions? Yes, no, maybe so. Is everybody just speechless that this is so good, or or is it like way over everybody's head?
This is Jason again.
What's
Can
up,
you hear me?
Jason? Yep.
Hey, as a new trader, I'm just still struggling with the lack of data that I would use for something like this, and I see the value. Are there other tools besides TrendSpider that I could use to sort of quickly test ideas and maybe get these setups, trade points where I might have taken a trade according to my strategy, and kind of populate a spreadsheet like this?
So, well, let's talk a little bit. So when you say that you're a new trader, like, do you like you found me somehow, right? So like you have an interest, like you're not saying like what's a stock, right? So now, well, what sort of books or things have you read up to this point?
Yeah, so I'm reading William O'Neill's book, How to Make Money
Okay.
in Stocks. I've read some books on chart patterns. I've read Mark Minervini's Market Wizard book, and I'm reading the latest Market Wizards book by Jack Schwager. And then just studying a whole lot online and on YouTube.
So
and I'm currently
actually
paper trading, but I'm
like
I'm not trading live.
So you have a pretty solid foundation of material that you could go through right there. Like, so you're familiar with O'Neill. The first 100 pages of his book, and I actually have it right over here on the shelf. The first 100 pages of How to Make Money in Stocks gives you, it's all charts, right? So you could go back in time on, well, what charting service are you using?
TradingView.
Yeah, so like you could just go through O'Neill and look for the types of patterns that he's using, or even use the ones that are highlighted in How to Make Money in Stocks. Let me see. That's the last one on page, or we'll use this one because I know that they're still around. First Solar, FSLR. Right, so well, First Solar, and I'm looking at page 108. Right, so let's go back to 2007. And if you were to apply O'Neill's rules, it looks like, and he was doing it on a weekly time frame. I'll just switch this one over. Save some time. The first buy, he points out, is right down here. So you'll be able to follow along using his rules that he outlined it. And we actually, in the, so for anybody that's in the Trader's Mind chat room, one of the things that I pointed out today was the idea of the frozen rope. Zenger is the first person that I heard use that concept, but it's very similar to O'Neill's concept of looking at almost like an ascending channel, but it's looking at a trend line that has multiple touches for, I believe it's 18 weeks or more, and then a breakout above that, that this is a major acceleration of the uptrend and that you're getting close to the end. And actually in How to Make Money in Stocks, he points out to when you get this break here to begin selling. Actually, it should be more like this logarithmic. And it's that break. So you'll be able to do pretty much this, and now you have a solid foundation of the types of trades you would be, or like not even what you would take, but just to see like how Cancelim works, how Minervini's principles work. Like you might have an easier time, like you could. Yeah, well, like how far? Like O'Neill goes back to the 1800s, but like as far as like the last chart in here is from 2007. Since Minervini's books are newer and have newer examples in it, you can use his books as well. Go through, see how he traded it, and then start to fill out a spreadsheet like this, so that way, like you could see the rules like as they're coming into effect, how your capital would be, and it's not just something that you're intellectualizing as you're reading through the book, but to actually see as the trades are developing, and well, what the winning streaks and losing streaks would be. And you could use his examples first, and then like as you get a better feel for the rules and principles that you're going to use, then you can go in and start to look for other trades, right? And like you could pick anything, right? Like we've got First Solar from 2007. You could use Amazon from the same period, right? Like you could use Apple. Well, when did like you could go back, like how many years could go back on Apple? You could start trading Apple from 1998, and you still see the same kinds of patterns evolve. And then it's like putting it into your sheet. Like let's say that we wanted to take this right here, right? We've got Apple, and like it's easy to see things in the past, but let's say that we saw this as a cup with high handle, and we were going to enter on this breakout here and have our stop loss down there, right? So that's probably very wide. It's probably like almost like a base on base. yeah, this is kind of like a, that's wider than I would take. But let's roll with this for a minute. Let's say that we were getting in right there, and we wanted to just trade this, and we were going to use a rule that said that we'll only exit on a break and close below the 21-day move, 21 EMA, right? This is a weekly chart, but let's just use the example. So we're using the rules under this test here. Sell everything on a close below the 21 EMA. Well, if we're doing that on a weekly time frame, then, and you entered here, then your first sale would have been over here. Right, like that's the first time that it actually closed. Did it close below it right there? The EMA was 1. Yeah, no, it closed right on it there. It doesn't close below it until right over here. So you would have ridden Apple for a 6R gain, right? You would have made 6 times your risk, and you would have made 108% on the position. So then you would go and you would log that trade in, and you would cultivate the types of ideas that you would want to trade. So like you have all your different setups or entries that you want to trade. You have your spreadsheet filled in, and then as you start to figure out, well, what if I only sold on a close below a certain moving average? What if I wanted to exit a trade once I've achieved a certain profit target? Then it becomes a lot easier to come back in, look at the same data, and just tweak one variable or 2 variables, and then see how that affects your SQN and and all this data. And then from there, you'll be able to make a judgment of, well, do I want to operate in a new way? How else can I add this in? Or did I find something else to not trade this way because I thought that it would be a good idea, but it turns out to be quite terrible.
Thanks. That's helpful for me.
Sure, my pleasure. Anybody else? Any other questions? All right, I'm happy to stick around and answer other questions, but if you guys don't have other questions, that's pretty much it as far as the presentation goes, and the idea, and like how to backtest it and how to use these sheets. And I really do hope that you guys will backtest. This is something that if I did it back, like when I first started trading, it easily would have saved me a fortune. And it's fortunate both in dollars, but more importantly in time. Doing this for this first test took a significant amount of time. Right, like from scratch, like setting this up, I didn't have like any. Like I wasn't drawing it from anywhere else. I looked around the internet for a little bit too to see like, well, what else have other people done? Like there wasn't. I didn't find anything that I liked. So I made my own thing, and it probably took me like a grand total of about 10 hours or so worth of work of entering in each one of these things and going through it and trying to figure out, well, what ideas do I want to test? And then flipping back and forth to the chart and seeing like, did we close below? Let's go to an actual trade. Let's look at a winner. Let's leave on a high note. Well, what's the biggest winner here? Well, one of the biggest winners. We've got this one. What is that? That's GSX. Let's reset all these charts. All right, so we'll come over here. Look at this on a daily time frame. All right, so we'll be flipping back and forth, like trying to get in like the first attempt for GSX back here in March didn't work out too well, right? Like I thought that it was forming this flag pattern, right? Like or the end of a high type flag that wouldn't even qualify as a high type flag at that point. It was more like potentially rounding out a cup. And did it work out? No. It broke out and then collapsed. All right, fine. That doesn't mean that we should give up on the idea. It just goes back on the watch list, or if you like me, you keep a universal list of ideas. And so that way, like it serves many purposes. Well, one of them being able to go back to an idea and continue to check it week after week and see, like, is it setting up again? And then it was setting up right over here in what's called the power play. You have a big run up off the bottom from down here, like it ran over 100%. Very tight consolidation, low volume. And for anybody that's familiar with Mark Minervini's work, you're familiar with the power play. And this is one of the things that he talks about. You got the breakout right there. It came within. Let's zoom in. I had my stop loss right below support, right? So 57, or was it 53.90? Over here, price came down to 54.29, right? That low was 54.22. Right? Like you don't want to have your stop loss too tight, but it should be below a correction low. And generally, being below a round number is a good idea too. I know that Stan Weinstein talks about that. I forget if Mark does that as well, but it's something that's worked out for me on many occasions, this being one of them. And it closed up and then proceeded to run. And so it would just be like flipping back and saying like, okay, well, in this test, where you're taking off progressively at each R multiple, that first test, like that was a challenging test to do because it's following price along like these R multiples are all calculated already, like all those gray fields, they're all pre-calculate. It's all a formula. So it's looking at what, like, how much are you risking, and then adding that to the entry price. And then for 2R, all right, what was your entry price? Then looking at the risk, multiplying it by 2, and then that's what price would be at 2R. So on GSX, where did GSX go? So on GSX, yeah, I would need to come over here and say that, okay, when did price get to 101? Is that the right one? I traded GSX a couple of times. That's from July 28th. Yeah, over here. GSX have a split? It must have had a split. In any case, yeah, like, and then that makes it challenging too to figure out where price would have been if you're dealing with stock splits on your data. It's not impossible to figure out. When I entered the test, like I wasn't dealing with that, but yeah, like that would be something else that I would need to figure out too, because I didn't enter at 50. I entered at 89. So it looks like it's a 2-for-1 split. So I would need to do that calculation. But you can see like how it's going through manually each time and entering all these. When you have a simpler idea that you're testing, like this one, like this, I was able to blow through in about 90 minutes for these trades. I think I had a Joe Rogan podcast on in the background. Question from Michael. Have you ever tested how much percentage on average a trade dropped close to your stop loss, but ended up holding above and still became a winning trade? It's not something that I've tested, but it's something that I've seen in real time. The two closest this year, GSX and PayPal. My stop loss on PayPal was 138.90. The price came to 140.02, so came within just over $1 of being stopped out. I've been, the closest that I ever came to being stopped out was about 5 cents on a trade. I forget the actual trade that it was, but it was maybe about, I'd say 2 years ago, maybe 3 years ago. But yeah, like it speaks to where to place your stop out. Like you want to have a, and this is why something else too. Like you would want to have like your parameters of where are you going to place your stops, and enter that into your sheet. Have your methodology, and then see. Like there's so much that could be extracted from this. Right, like beyond just what your statistics are, right? Like you know what your statistics are, but then you start to think of, well, what would happen if I set my stops up below weekly support instead of below daily support, and that became a rule, right? That would really alter so many things, right? Like that would alter your position size. That would alter how quickly you would be taking trades. Like you might end up taking far fewer trades. There's many different things that you could test. But as far as closest stop, yeah, well, within a few cents. And I should also point out too that being stopped out of a trade and then having it rally in your face, that in and of itself does not mean that you placed the stop incorrectly. What's correct or not is, did you follow your trading plan? If you followed your trading plan, then you were correct. If you did not follow your trading plan, then you're incorrect. If you do not have a trading plan, then anything that you do is incorrect. Right? Because how do you improve if you're just kind of like closing your eyes and throwing darts at the wall? There's no edge in that. But if you are consistently following your plan, and then you could see if what you're doing is working, generating profits, or if it's not. And if it's not, then that gives you something that you could go back, evaluate, and come up with new plans. Great question, Michael. Thank you. Other questions? All right, I think then, unless there's any other questions, I think that that's it. I'll give you guys a moment um, to like if you're typing, I'll give you an extra moment or two to type in. But if that's it, then we'll wrap things up. Again, this spreadsheet, an Excel version of the spreadsheet is already up in the members dashboard. So if you are a Mara Elite member, just log in. You could come over to resources and you'll be able to download the backtesting template in Excel. And then if you want to use it in Excel, great. If you want to copy and paste this straight into Google Sheets, you absolutely can. And I'll send out a PDF of this. The recording will be up in the members dashboard as well, in the boot camps area. They'll be right there alongside all the other boot camps. You'll be able to watch this one. It'll be up within, I'd say give it until later this evening. It takes the video a little bit of time to render to get up, but it'll definitely be there up there later tonight. Of course, if you have any questions about anything, feel free to reach out to me. You guys, as Mara Elite members, whoever is a Mara Elite member, you have free access to the Traders Mind Chat room. So just go straight there, put in your questions, and yeah, that's about it. Yeah, a lot of great and interesting trades recently too, right? Like with some of these, like with Ethereum, that trade is just taken off. But anyway, I'm getting way off topic here. All right, guys. Looks like that's it as far as questions go. I want to say thank you all so much for joining me today. I really appreciate it. I hope that you got a lot out of this. Feel free to email me as well. You all have my email address. And thanks again. All right, everybody. Take care. Happy trading. Much love. Peace out.